Okay, let me go back 1 second. Jim, I don't know why I didn't see your comment come through. And I get this isn't Jim's comment, but I get this a lot. This isn't the one we want, is it? We want the better one that we were looking at, not the 76, but the one that was 80. Was I at 83, 83, 81? Yeah, 83. And then you might have been talking about the other one, Jim. Here, I'm going to say something quickly here, and this is not against Jim at all, Jim. I don't mean it to sound like this, but I just want to point out something that Irene pointed out. Irene just said she is new to options. And she's learning here. She was in a fast lead position, but she needs to see how to manage the positions here. She's getting into it, needs a little bit more education. At times, I have a tendency that investors have a tendency to sometimes say that I talk too fast, and they're trying to figure and they're trying to follow along with it in these cases. So it's very difficult to kind of follow along with this kind of material. And I do appreciate that. And when I do a non-live recording, the open forum Q&A is always a little bit faster. It's always a little bit different with the materials. I do understand that. But we just showed 3 kind of complex ideas to manage a position. The pendulum is kind of involved. If you don't know it right away, it looks simple just to move something, but you have to consider that you're changing a bull put to a bear call. I'm sorry, a bear put debit. You're changing a credit to a debit. It's weird when you see it. And then, of course, doing a bear call and adding it to an iron condor, that comes with other complexities. Which strikes to choose? Which probability do I want? How much money do I need to make up? Or simply even rolling down the bull put, which new one do I go to? How do I have to increase the strikes? How do I have to increase the number of contracts to get back this premium that I need? One thing I do not go into, and I think I might have touched upon this. I don't remember. I think I was going to say it at one point. I do not try to teach new investors these elaborate management techniques of converting a single credit spread into some form of ratio broken wing butterfly for a potential repair on the position where you have not addressed the downside that you could still lose on if the stock continues to go in the same direction. That's not Jim's comment. But Jim added a comment here. Why not do a ratio back spread by buying another long put prior to it crossing the short strike, then taking the shares and putting on a short call, converting to a collar? Now you have double long puts, a short call, and a stock. One of the reasons I never mention that directly as a way to, not even in that, but just using the stock or short stock position as a way to manage it, is most investors who are trading the credit spreads are trading the credit spreads in their portfolio because they don't want to use the money to put into the stock to do that. So let's talk about this here. Buy another long put prior to it crossing. Well, we've already crossed, but let's say now I buy another September 25 81 put, which is now at 240. It hasn't crossed the short put strike price, but it's down here. Okay, so let's just add another one at the new price of 250. So it started to go against me. Now I've got a ratio back spread with a break even to see profit is way down here. Oh, okay, Jim, you're talking about something different. I'm sorry, my apologies. You're talking about if I got assigned on this position, okay? Why not let it get assigned and then convert it to a call or a married put? Only if I wanted to own the stock, okay? And in general, if I use a naked put, I only sell a naked put, a cash secured naked put, Jim, on a stock I would not mind owning, okay? But if I did get assigned the stock in this case and I still had a bullish outlook for it longer term, then yes, maybe I'd buy an extra put here. Now I take the stock. I take the stock at 83. So he's talking about in that other example, let's say the stock fell below my short put strike price next week's expiration. We get put the stock, and this put's going to expire. Right? That's kind of the case. If I held it to where the stock was put to me, my long put's going to expire. So now what you're mentioning about is before it crossed the short, buy the put, and then you're in a position to now let it be assigned and convert it to a collar. I just think that's too complex. I think that's too many working pieces where I'm timing to buy the put before it crosses below my short put. So I have an extra put that's now further out in time, allow the stock to go below my short put strike price, my original short put strike price in that case, have the other long put expire potentially, or cash out of it depending, and then convert it to a caller by selling a call against the position. Most people who are trading the spreads this way don't want to be put the stock. You have to be prepared for it, Jim. You're absolutely right, but they're not planning on ever being in the stock. We want this to expire and to move on to the position. In a cash secured naked put, I may take assignment, because specifically in a cash secured naked put, I will never sell a cash secured naked put on a stock I would not want to own. Okay, in that case. And so that's why I would do it. But in the bull put, I'm not hoping for it, but that's why I always mention the 1% rule, Jim. I'm going to close that short put before it goes in the money. If it reaches within 1%, and the few times it has dropped suddenly, where it was 3 or 4 points out of the money above my short put strike, and then I'm going to, and then I suddenly wake up and it's between the strike prices, that's when I've used the pendulum adjustment, because I didn't want to buy the stock. I didn't want to risk being put the stock, which can happen if it's in the money. But again, those sort of elaborate turn it into a back ratio. So Sam had even mentioned, you have to use more margin when you do the iron condor. Yeah, it's because your broker's not going to see it as iron condor. They're going to see you have a bull put. Now you've added a bear call. So that's going to increase your margin as it is. He did mention that you could also turn it into a back ratio, which is a little bit more complex that I think a lot of investors want to do, but it might be a repair. And adding a ratio spread or turning it into a ratio back spread may work when it's between the strike prices as well. Sam, you also followed up and said, don't lose more than half. That's the goal, is to keep it there. And Sam says, when you're looking to maybe convert this to the, let me see if I can just go back here. It's probably, there we go. If you look to convert it to the iron condor position, you would look to sell calls when the stock touches the upper Bollinger Bands and sell puts when the stock touches the lower. That's one way of doing it on the technical as well. I typically don't, even though you saw it on my profit and loss chart, this is what Sam's talking about, the Bollinger Bands. So he's saying you sell puts when you hit the bottom here, the bottom Bollinger Band, and it's looking pretty good, but then you sell the calls when it's up at the upper Bollinger Band in that case, sort of doing support and resistance in a sense as well. And then Ahmad came in with a question. It says, when it comes to position sizing and bull put credit spreads, is it better to widen spreads or multiply contracts? Well, I think, Ahmad, any position, it doesn't matter. Mathematically, it comes out the same, Ahmad. Okay, when it comes to position sizing, what I look to do is to make sure that each bull put does not represent more than 5% of my total portfolio value. So that if I get stuck with one position that just suddenly opens up against me, Ahmad, and has that maximum loss that we saw for Fatsley on the September 11th series in that case, and it's suddenly at a 97% loss, that's only 5% of my total portfolio. That's one of the reasons why I don't like doing the rollouts or just rolling down to a new bull put or rolling up to a new bear call, because if I have to increase the contracts, Ahmad, or I have to increase the strike price differences to double it, to get double the net credit, what am I doing? I'm now taking on a position that represents 10% of my portfolio that had already gone against me once, and I don't want to do that. Sam on that follow-up said position sizing has increased more than 2%, which doesn't match my trading plan. The same thing that I'm in, Sam, as well. That's why I don't like increasing the strikes or doing an elaborate spread that potentially increases too much of the risk, because I need to keep that margin requirement at 5%. I want to keep that margin requirement at 5% of my total portfolio value in that case. All right, so we are at 6 after 6. Just some follow-ups from Sam. He said, just for fun, I bought 110 calls in Apple 2 months out, expiration. Maybe the stock goes lower or go up. I'll manage it with the coming moves, as he mentioned. It's 22% below its 52-week high. I'm sorry, yeah, below its high. And then you're looking at call spreads on IWM. IWM is an interesting one with the volatility that's still there. It was in the money, lost out the total spread, though, this week. It's a 150, 153 spread. And you're still doing the straddles on SPY and IWM, and they are 90 days out in time. And Sam said in regards to the Bollinger Bands, that idea of selling calls when you hit the top of the band and selling puts when you hit the bottom of the band works really well for SPX and SPY as well. All right. Well, ladies and gentlemen, if anyone has any last-minute questions, I suppose you can go ahead and send them in, but we are 10 minutes after 6 o'clock here. So just wanted to remind everyone, of course, that, there we go. I just want to remind everyone that today's material are my thoughts on your questions designed for educational purposes, increasing investing knowledge, and options performance. Sorry about that. Any stocks or options discussed today should not be taken as a direct recommendation or suggestion. Options, as we have seen, do involve risk, and it may not be suitable for all investors, but we're going to keep doing our best to get the education out there that you need to see some of the pitfalls of things that can happen, see ways that you can manage out of those things if they do happen, and of course, try not to get too fancy with some of those repairs so it still keeps it simple and it keeps us on the right path as well. Okay, let's see here. I need to go over here. There we go. As we saw today, we mentioned, remember, you can go to poweropt.com at any time to take a 14-day free trial to the services. Use the tools we saw, such as the back testing, the regular patented search tool for the various strategies, analysis, and the portfolio tools. We looked at the Greeks view and some of the other tools that you can use inside the portfolio, the research and analysis, and much, much more, plus access to all of the webinars. You can just take your trial. Only need name and email address. No credit card information is required for your 14-day free trial. So just do that at poweropt.com at any time. After that, the subscriptions start at only $45 per month. Our most popular service is the 20-minute delayed service. Gives you access to all of the tools, of course, without the historical data, with delayed quotes, about 15 minutes. That's $65 per month. Then the upgrade to the historical is just $35 more. So you'd have the 20-minute delayed service plus access to all those back testing tools we looked at for Lloyd today, and that's $100 per month. And we do offer that real-time service and the premium, which is everything. Well, other free information, hey, we already showed you the webinars page twice. You always have that access. There's a lot of other content that's posted to YouTube also. You just look up Power Options on YouTube and just scroll through our recent videos from our Friday sessions and more. And you can also check out the blog, blog.poweropt.com. Well, if you do think of any other questions later on, please feel free to send me an email at any time to support@poweropt.com or support@radioactivetrading.com. Wow, we didn't really talk about married puts today. Did a little bit for Octavio, but not too much. That's interesting. All right. But anyway, you can also call the office during market hours at 302-992-7971. And remember, trial members and subscribers, you can schedule those free coaching sessions at any time. Essentially a 35 to 45-minute phone conversation or more if needed with myself or Ernie. We'll walk you through the tools on the site, answer any questions that you have, just like we kind of do here on the Friday sessions as well. Kip, it's so good to see you here. Great. Kip says, great session, Michael. Have a great weekend. Thank you, Kip. You do the same. Sam says, thank you. Sell Apple calls, I think, more downside to come. I'm thinking so too, but we'll have to see. Jim, thank you. Thank you for your questions, Jim. Jim says, great session. Thank you, Mike. Sam says, have a nice weekend. Enjoy. Stay safe. 6 feet apart. You too, Sam. Stay healthy. Sam, I've already had 2 sips of wine. That's what you heard me with today. I'm having a something that the liquor store owner turned me on to. It's a mix of a Malbec and a Cabernet. It's pretty interesting on it. A little peppery, but pretty good. That's the Malbec side in there. But you too, Sam. You have a great weekend and relax. There as well. Time lost does not come back, says Sam. That's great. Irene, thank you for your great question. Of course, Ahmad, thank you for your great question. You both have a nice, safe weekend as well, and take care. And Fernando says, sometimes I don't understand if my repair structure is good for my portfolio or for my ego. I still have the same problem from time to time. But through these past several years, almost 5.5 years now, 5 years, I've been trading the bull puts with a lot of my portfolio and trying to perfect the technique, which really I feel I did a year ago or so. Felt really comfortable with the things that I'm doing there. Just rolling down the put never seemed to work for me. It was the most easiest adjustment to make when the spread starts to go against you. Hey, just close your bull put, roll down to another, and it'll come back up and you'll be successful on that one. I don't think I ever had luck doing that. In the testing cycles I did, or when I started testing my own management techniques, I don't think it ever worked out as I planned. The stocks that went down against me just to continue to go down. And that's why, Fernando, you always hear me say with sort of smile and a little bit of confidence, I would just rather close the position and move on, forget about that particular stock for the time being, and try to make back that loss by getting 2 or 3 other successful, in this case, bull puts that are going in the direction that I want. All that being said, I've got that one married put position on semiconductors in the Fusion portfolio that I've been in for almost 600 days. It was profitable at one time, took a loss. I rolled the put down. It took more of a loss, managed it back up. And then at this point, I did the income method number 5, a stock repair on it. It didn't work out as I wanted to because we pulled back. So I rolled that income method number 5, that stock repair, into another stock repair to November. It's an 8% loss right now. And I'm just saying to myself, why am I not just taking the 8% loss and move on? Honestly, I'm trying to make it look good. The stock's at 21.20, 21.40 right now. If it goes up to 21.82 by mid-October or towards the end of October, it'll be a profitable position instead of an 8% loss. That's ego. I'm just not letting myself take a loss on this on position, even though I've been in it for 580 days. The stock's down, 12, 15% from where I got in. I'm only a loss at 8%. I should just get out, but no. Don't fight the losing battle, says Sam. You're absolutely right. But I kind of like the stock repair, and it's also good because it's only the on semiconductor position is in that portfolio, but it's a low price stock, and I think my total investment in it is $2,500. It's just 100 shares. So this is going to give me some fodder for education for the radioactive trading site on following this position, what I did extremely wrong, what I did right. And with $2,500, and I can't lose more than that 8%. That's the other benefit of the married put right now. I can't lose more than that 8%. But if it goes up just a little bit, I'll be back to break even with the stock still down 10% from when I got into it. But we'll see. We'll see in that case. All right. Well, enough of that. You guys take care. Thank you again for joining me on this Friday afternoon. I hope everyone did have a happy expiration. It seems like many of you enjoyed the presentation today. I'm very thankful for that. Everyone be safe, stay healthy, relax, de-stress this weekend, and we will all see you next week and beyond as well. But for next week, we'll see you on Friday, and if not before then, with one of our other weekly presentations. Take care, everyone. Good night.